If you're tired of getting stopped out within minutes, chasing price, and losing money on noisy lower time frames, this strategy is for you. Next time, I'll show you a simple way to filter weak signals and identify better reversal setups across different markets. Before we begin, don't forget to subscribe to Paradise Trading Tips and type 1 in the comments below. I'll also share a few real market examples so you can see how I personally identify the setup, choose an entry, place the stop loss, and manage the trade. The core of this strategy comes from one concept that changed the way I read price action: market manipulation. Once I understood it, I stopped reacting to every candle and started seeing why price often moves in certain ways. So what is manipulation? Simply put, manipulation happens when price temporarily breaks an important liquidity level, attracts traders into the wrong direction, and then quickly reverses back the other way. Let's look at an example. Let me share a simple example that helped me understand this concept more clearly. Imagine there is a strong support level that has already held price several times. Like most traders, I used to believe that price would bounce again when it returned to that level. My plan was usually simple: buy near support, place the stop loss just below it, and wait for price to move higher. But the market doesn't always move the way most people expect. Instead of bouncing immediately, price often drops slightly below the support level first. This move triggers the stop losses of many buyers before the market suddenly reverses and rallies upward. I was right about the direction, but I was removed from the trade before the real move even began. This is exactly what traders call market manipulation. The market first removes liquidity by triggering stop losses and attracting breakout traders, then reverses once enough liquidity has been collected. Now, some of you might ask, what makes manipulation so unique? Why do we use this concept as our strategy? Manipulation often appears near important turning points in the market. Once the liquidity sweep is complete, price frequently begins a strong move in the opposite direction, which means if we can properly time our entry during a manipulation move, we could potentially capture a large price move, giving us a good risk-to-reward trade. The good news is that this strategy is surprisingly simple. Instead of using dozens of indicators or complicated rules, we'll break everything down into 4 easy-to-follow steps that anyone can understand, even if you're a beginner. Now let's move on to step 1 of the strategy, which is identifying a liquidity level. In simple terms, it's an important price level where the market changes direction after making a strong move. Price approaches that level, reacts aggressively, and then travels a noticeable distance in the opposite direction. The last swing high before a strong bearish move, or the last swing low before a strong bullish move, often becomes a liquidity level, which you can mark by simply drawing a line. Most retail traders naturally place their stop losses above swing highs or below swing lows. As a result, these areas accumulate a large amount of liquidity. Here's a simple rule that can help you. If you have to zoom in, overanalyze, or spend a long time searching for a liquidity level, it's probably not a high-quality one. A good liquidity level needs to be obvious, something other traders can clearly see as well. For this strategy, I recommend marking liquidity levels on higher time frames, such as the 1-5, minute 30, minute 1 hour, or even the 4-hour chart. Let's look at a real example. In this chart, we're using the 1-5-minute time frame. That swing low is easy to recognize because the reaction afterward is very strong. This makes it an excellent liquidity level to monitor. Once we've identified our liquidity level, we can move to step 2, which is waiting for a manipulation. So, as discussed, a manipulation simply means price sweeps a liquidity level. In this example, we wait for price to break below the liquidity level like this. Once the liquidity sweep has occurred, we're ready to move on to step 3. This is the most important part of the entire strategy because it determines whether the setup has enough confirmation to become a high probability trade. Before we continue to the next step, I just want to let you know that every single day I share market analysis, trading ideas, and high probability setups inside the Paradise Trading Tips community. Now let's move on to step 3. The confirmation we're looking for is called an inverse fair value gap, or IFVG. This concept helps us confirm that market momentum has truly shifted after the liquidity sweep. A fair value gap is formed by a sequence of 3 consecutive candles. It appears when the market moves so aggressively that the first candle and the third candle fail to overlap completely. This leaves a visible price imbalance between them. So remember, if there's no gap, then it's not a fair value gap. The key point to remember is very simple. If there is no visible gap, then it is not a fair value gap. A true FVG must show a clear imbalance on the chart. However, this strategy doesn't use a normal fair value gap. Instead, we're looking for something slightly different and much more powerful, an inverse fair value gap. It happens when price returns to a previously formed fair value gap, completely breaks through it, and then closes on the opposite side. This shows that market control has shifted from buyers to sellers, or from sellers to buyers. In other words, the original fair value gap no longer acts as support or resistance. Instead, its role has completely reversed, which is why we call it an inverse fair value gap. Now let's apply this concept to our chart. Since we've already identified the manipulation, our next job is to look around that area and check whether an inverse fair value gap has formed. Right after that, we can see price breaks above the fair value gap and closes above it. So now we officially have an inverse fair value gap. So let's recap what we currently have. First, we identify a clear and obvious liquidity level that stands out on the chart. Second, we wait for the market to perform a liquidity sweep, also known as market manipulatio. Third, we wait for an inverse fair value gap, IFVG, to form near the manipulation. Once all 3 conditions are confirmed, we can move to step 4, the trade entry. For a buy trade, the entry is placed at the closing price of the inverse fair value gap confirmation candle. The stop loss should be placed slightly below the inverse fair value gap to protect the trade while allowing normal market fluctuations. Or if you're aiming for a bigger move, you can instead target the liquidity resting at the highs. And in this setup, price moved up and hit that take profit level. Now, as promised, here are some real trade examples of the manipulation strategy in action. After testing this strategy across multiple markets, I found that it performs particularly well on futures, especially when trading lower time frames such as the 3-minute chart. Let's walk through this chart step by step. The first thing we need to do is identify a valid liquidity level. Looking at the chart, we can clearly see that price declined into this area before producing a strong bullish reversal. Since the reaction is obvious and easy to recognize, this becomes our liquidity level. With the liquidity level marked, we move to step 2 and wait patiently for manipulation. Shortly afterward, price breaks below the liquidity level before quickly reversing higher. This sweep of liquidity is exactly the type of manipulation we want to see. At this point, we can confirm that we have a manipulation of this liquidity. Now we move to step 3, looking for the inverse fair value gap. On this chart, we can spot this large red candle right here. You can see there's a very clear gap on the body of the candle, which makes this a fair value gap. Now, for this fair value gap to become an inverse fair value gap, we need to wait for price to break and close above it. And once that happens, that's when we officially have an inverse fair value gap. So just to recap everything so far, first we have a liquidity level, then we see manipulation of that liquidity, and finally, we get an inverse fair value gap. When all 3 conditions are met, that's where we take a buy position. We enter a buy trade, place the stop loss just below the inverse fair value gap, and set the take profit at 2 times the risk. As the trade develops, price continues to climb and eventually reaches our profit target, delivering another successful 2R winning trade. Now, this strategy also works the same in the opposite direction. Let's see an example. So far, every example we've covered has focused on bullish reversals. However, the market doesn't only move upward. We're now looking for liquidity resting above recent swing highs. Let's walk through a real bearish example. First, we identify a clear liquidity level at a recent swing high. This level is obvious on the chart and is likely being watched by many traders. Next, we look for an inverse fair value gap. And in this case, we have this large green candle with a very clear gap on its body, which makes it a fair value gap. For this fair value gap to become an inverse fair value gap, we need one final confirmation. Instead of entering the trade immediately, we patiently wait for price to move back, break through the fair value gap, and close below it. Once that happens, we have a valid bearish setup. At this point, we now have a complete bearish manipulation setup, meaning all of the required conditions have been satisfied and we're ready to execute the trade. And as you can see, price moves down and cleanly hits the take profit target. Now let's look at another real example, but this time on a completely different market. Here, I'm using it on the Bitcoin chart, and you'll notice that the indicator automatically looks for the strongest liquidity level. As soon as the indicator starts scanning the chart, it automatically identifies the strongest liquidity level without any manual drawing. This saves a significant amount of analysis time. Then once price breaks below that gap, it prints a red mark on the chart, signaling that this is a valid bearish manipulation setup, which can be a potential sell trade. We then wait patiently for the final confirmation. Once price drops back through the fair value gap and closes below it, every trading condition is officially complete. Now, if you want to copy the exact settings I used in this video, you can slow this part of the video down. One of my favorite things about this indicator is that it's built entirely around pure price action. It doesn't rely on lagging indicators or complicated mathematical formulas. Instead, it analyzes how price actually behaves in the market. However, I want to make something very clear. This is not the type of indicator where you simply buy whenever you see a green signal or sell whenever you see a red one. Professional trading doesn't work that way. You still have to analyze the setup before actually taking the trade. The indicator simply saves you time by automatically screening for potential manipulation setups. Every trade should still be supported by your own market analysis. Before entering any position, you should always evaluate the overall market structure, nearby liquidity, risk-to-reward ratio, and whether the setup truly fits your trading plan. Think of this indicator as a smart assistant rather than an automatic trading system. Its main purpose is to scan the market continuously and highlight potential manipulation setups that deserve your attention. Instead of spending hours searching through dozens of charts every day, the indicator performs most of the screening for you, allowing you to focus only on the highest quality opportunities. If you found this video helpful, don't forget to hit the like button, subscribe to Paradise Trading Tips, and turn on notifications so you never miss future trading lessons. Thank you so much for watching and supporting the channel. I truly appreciate your time. Trade with discipline, protect your capital, and I'll see you in the next video.